I'd like to thank everyone for being here today. My name is Jeb Gerald. I'm so excited to talk about what's going on in the market and what's going on in the economy. It's a pretty confusing time right now, and it can be kind of hard to figure out how things are going to affect another. Today, I'm going to be talking about what's going on in the economy and what you can expect over the next few months. I'll start out, jump right in. I'm going to be covering three things really. The first is what are the current economic and market conditions? Is the economy good? Is it bad? Is it pointing towards something worse, or is it looking pretty good? From there, I'm going to talk about some specific risks that we're seeing, that I'm seeing, that could affect things and could change the outlook. And finally, I'm going to talk about the reason why you're probably here, and that's what should we do? How should we invest? How do we take advantage, or how do we protect our portfolios from what's going on right now? So with that, let's get started. First off, let me give you a quick 30-second introduction. For those of you who don't know me, my name's Jeb Gerald. I've been doing this for about 10 years now, and I run Plentiful Wealth. We're a wealth management firm that focuses primarily on working with retirees and those plus or minus 5 years of retirement. Just so you know my background, so you know I do know what I'm talking about at least a little bit. My undergraduate degree is in economics. I have a master's in financial planning, and then some other designations because I keep going back to school because I'm a nerd and I love learning. So that's me. That's where I'm coming from. And now let's talk about the economy. First up, think about the economy for a second and give it a letter grade. Think back to school. If you had to rate it A, B, C, D, or F, what would you give it? Okay. I'm guessing most of you are probably thinking somewhere in the C range. Pretty average, maybe C minus, not great. I'm going to come back to this here in a minute, but just hold on to that thought. Let's look at the data. What does the data actually say about the state of the U.S. economy? We'll look first at unemployment. If you look at the top graph, you can see this is from COVID on. You'll see a big spike in 2020, went up nearly 15%, which is amazing, absolutely amazing. It's terrible, but it's a crazy high number. But since 2022 or so, it's basically stayed in the high 3% range. On the bottom, you can see the historical range over the last 20 years, and we can extrapolate that we're actually pretty much at the low point over the last 20 years. That's great news. We're actually at the point where we have pretty much a full employment. Most people, if you talk to economists, they use the term NAIRU, or the natural occurring rate of unemployment. And that just means that once you get below a certain unemployment level, it actually causes inflation. And we're pretty close to that. So that's pretty good so far. Next up is inflation. And if you've been watching the news, you saw that inflation has been higher than expected the last couple readings, January, February, and March. So you can see starting in early 2021, that's when inflation really spiked. We hit nearly 10% inflation. That trended downwards till mid to late 2023, and we're seeing a small rise since then. Problem here is that as inflation goes higher, or if it even stays where it's at, right now we're in the low 3% range, 3.2, 3.3. That takes away the Fed's ability to cut rates. And right now, rates are driving everything. Retail sales are super important because they are a great gauge of the health of the consumer. When you look at the economy, about 60% of spending, 60% of GDP actually comes directly from consumers. And from here, you can see that sales are continuing to go up. So on that, things look pretty decent. And then what has the market done so far this year? I broke this out into 5 different indexes. The big takeaway for me here is that across the board, it's been a pretty good year. When you look at the S&P, the NASDAQ, or the Russell 3000 in the blue, purple, or orange, those are all up around 6 to 7% this year. That's really solid so far since we're only, 3.5 months in. When you look at the Dow Jones, which is the larger blue chip industrials, basically broken even, kind of flat on the year. And then finally, when you look at the US Treasury, this is the 10-year Treasury specifically, it's down about 3%. That's not great, and that's pretty unusual. But that really goes back to the inflation that I mentioned earlier, because at the beginning of the year, most people on Wall Street were expecting somewhere between 4 and 6 rate cuts this year. They expected the first one would start by March, and the Fed would cut rates by about 1.5% throughout the year. Since inflation spiked again, that number has completely changed. Right now, most economists are saying somewhere around 2 rate cuts for maybe 0.4% of total cuts, maybe 0.5. When that happens, that means that bonds are going to be repriced. So as yields go up, prices go down, and as prices go down, yields go up. That's where we're at right now. Yields have gone up, prices have gone down. That's why the 10-year Treasury is down almost 3% on the year. When you break out the S&P into its sectors, there are 4 sectors that have outperformed the overall index on the year. 2 of them, communication services and information technology, are really similar when you look at their constituents. We're talking NVIDIA is one of the big names. You're looking at Apple, Amazon, Microsoft, the big tech names. They're going to fall into one of those 2 categories. Energy's outperformed. When you look at crude oil, the price of crude has gone up. We're almost at $90 a barrel. A lot of that is due to the stuff I'm going to talk about later, what's going on in the Middle East. And then industrials. Industrials covers a whole lot, but kind of goes back to manufacturing, goes to the fact that people are still buying things. So those have all done really well. On the bottom of the list, real estate and utilities. These are interesting because real estate and utilities are both super linked to interest rates. Utilities are linked to interest rates because most utilities, they run on a lot of debt. So when they're financed by debt, as debt comes due, they have to refinance. They have to refinance from going from 3% rates to 6, 7, 10% rates. That's going to affect their bottom line. Likewise, real estate. When you look at real estate, it's price based on interest rates as well. And so when it's price based on interest rates, and you go from cap rates specifically, when you go from a 3 cap or a 4 cap to a 7 or an 8 cap, it's going to cut the value of that real estate in half. So we're seeing that a lot, specifically in the office market. And many of the big office REITs are feeling the pain from this. So now let's talk about why the economy feels bad. Like I said, most people would give the economy somewhere around a C. And a lot of that comes down to 3 different things. First is housing affordability. Housing affordability is at an all-time low. You actually can't see it in this chart because I accidentally cut it off in 2020 or so, and I apologize for that. But just know that housing affordability is lower than it was in 2006. So that's why you hear so many millennials and Gen X and everyone else too saying that they just can't afford to move. They can't afford to move up to that next house like previous generations were able to. Or if they weren't able to even buy in the first place, that's also something I hear that my peers saying all the time. On the right side, you'll see the purchasing power of $1. Again, apparently I can't crop very well, but starting in 2020 till today, it went from $1 in 2020 is worth 80 cents today, 20% lower. So that just goes to show you when you hear about shrinkflation, when you hear about lower purchasing power, that's what we're talking about here. And then finally, I think this is the biggest part, and this goes back to the purchasing power as well, but the price of groceries and the price of food. I don't know about you all. I have 2 kids, and when my wife and I take our 2 kids to go to Chick-fil-A, we spend $50 or $60. And that blows me away that we can spend that much on fast food. But just looking from 2020 till today, the price of food is up 25%. That's even more than the actual rate of inflation by itself, or total inflation. So when you think about the things that you buy on a regular basis, it makes such an impact, and that's what we feel. So that's one of the reasons why so many people feel like they're strapped at the end of the month is food prices are just going really, really high. Question I get a lot is, are we headed towards a recession? And if you'd asked me pretty much any time last year, I would have said, yeah, I think we are. Or maybe that we're already in a recession. I've said that several times. Turns out we actually weren't, or at least the data didn't show that we were. And now when I look at the data and just kind of look at big picture at this, it's actually getting better. If you start at the right and you work your way to the left from September, December to March, you can see that we have less red X's on the left than we do on the right. Um, Housing growth is good. Job sentiment still isn't great. Jobless claims are fine. Retail sales. Really, the couple things that stick out, the biggest one is the yield curve. Because you've probably heard, hey, the yield curve is inverted. Typically, that indicates a recession within 18 months or so after it inverts. We're right at 18 months right now, and there's a lot that goes into it. And honestly, economists will argue over that for a long time. But just know that right now we seem to be in a pretty okay place. There are some really frustrating factors in the economy, and there are some reasons why it doesn't feel great. But if I had to give the economy a grade, I'd probably give it a B minus, just because most people that want a job can get a job. They might not make amazing money, but we are seeing wage growth. Their money isn't going as far as it did, but most people are still doing okay. And that even goes back to revolving credit, consumer credit, and the amount of disposable income at the end of the month. So overall, things seem to be doing okay. Next, let's talk about the second section, and that's geopolitical and economic risks. There are 4 or 5 main points that I want to cover in here, and I'll jump right in. First thing is that, and this is on most people's minds because this is all the TV is talking about right now, is what's going on in between Israel and Iran. I don't want to get into the whole history of it, but just know that Iran has spent the last 20 years trying to expand their power in the Middle East. They're trying to become the major regional power, and Israel stands in the way of that. And even worse for Iran is that Israel has actually strengthened relationships with some of their neighbors, specifically Jordan. They have a defense pact with Jordan. They are on track for normalizing relations with Saudi Arabia. And then they also have pretty decent relations with Egypt. So put all that into effect, and you see a coalition against Iran, and Iran doesn't like that. So one of the reasons why they potentially influenced the October 7th attacks was to actually disrupt the agreement, the normalization between Saudi and Israel. Just know for Iran's military that they don't have a super up-to-date modern military. They have pretty good capacity. They're building a lot of the drones that are being used in Russia against Ukraine, and they have really good proxy force strength because that's something they really built out because they know they've built their force to go against the United States. And, starting in Iraq in the early 2000s, they were equipping Iraqi forces with EFPs that killed our guys. All that is asymmetric warfare. They have the IRGC, the Revolutionary Guard, and they go spread dissent and terror everywhere they go. They spend money, they provide training, they provide supplies. So I'll come back to this more later, but that's something to keep in mind. I mentioned Iran's proxies. You can see right here. They essentially surround Israel. Some in the West Bank and Gaza, of course. Lebanon. In Lebanon, the southern part of the country is essentially de facto governed by Hezbollah, who is very, very deep with Iran. Syria, they support the Assad regime. In Iraq, they're very popular, which is ironic considering the 80s Iran-Iraq war, but Iraq is primarily Shia. When it was ruled by Saddam, I probably don't need to get into this too far, but Saddam was Sunni, and there was a Sunni majority that ruled the country. But now it's essentially ran by Shias who are more open to working with Iran. And then Yemen as well, because I'm sure you've heard about the Houthi rebels who have fought Saudi Arabia for the last 10 years, and then also who have been lobbing missiles at any shipping that passes by the Bab el-Mandab. Touched on this a second ago, but just know that there was likely some connection between the Hamas attacks on October 7th and the IRGC. The extent of those links, we might know eventually, but they're not certain right now. It's expected that there was a pretty decent connection there. This brings us to 2 weeks ago when Israel actually bombed part of the embassy in Damascus. the Iranian embassy in Damascus, specifically to take out one IRGC general who was reportedly involved in the October 7th attack. Because embassies are sovereign states, because they're a sovereign portion of the nation they belong to, Iran retaliated. As of last, I guess it was last Saturday night, they shot 300 missiles and drones at Israel. Luckily, almost all those, 99% of those failed or they were taken out. And one of the interesting things is Jordan actually launched fighters that took out some of the Iranian missiles. So that's kind of a big deal that an Arab state stepped in to defend Israel against another Muslim nation. Iran's attack actually kind of walked a fine line. In the Middle East, going back to trying to become the regional hegemon, you have to punch back if you get punched. It's just part of the culture. But I have to say, when they did this, when they attacked Israel, it wasn't an all-out attack. They could have gone a lot harder, having Hezbollah involved, having attacks from the West Bank, having a lot of things there. They really telegraphed the fact that they were going to attack, which means that they probably weren't trying to actually cause damage, or at least not civilian or collateral damage. They also didn't actually attack civilian infrastructure. It appears that as of now, and I say that a lot, but so much of this is, we're still finding out, we're still learning more. But so anything I say today, it's as of this moment. They telegraphed it, and they specifically tried to attack military bases. The only one that actually got hit was down in the Negev desert. It appears that they had just a couple missiles that actually made holes in a couple runways. There was one girl that was hit by shrapnel, and that was really sad, but it doesn't seem like that was intentional. After the attack, Iran notified the UN that they consider the matter closed. My takeaway here is that they wanted to punch back, show that they could punch back, but not escalate into a full-blown regional war. Problem with that is there's two sides to everything. Israel's been punched now, and it's their turn because they're facing the exact same question as to how do they react. They've already said that they will retaliate. The question is to what extent. If they go too hard, then it is very likely that it becomes a regional war. But if they actually measure their response, hopefully it doesn't happen. There are a couple questions as to what is going to guide their response. A big part of this is going to be internal politics. When you're looking at their domestic politics, Benjamin Netanyahu isn't super popular. He's had a whole lot of pushback from October 7th for how that was missed, how the preparations were missed. And he really relies upon hardline conservatives in the Israeli government. So if he follows with them, then it's possible he pushes a more hardline attack. Something harder attack, and I'll go through a couple of different options in a minute, will be more likely to escalate. That also brings potential of bringing the U.S. into the mix. As of right now, the U.S., through President Biden and through General Austin, have essentially said, yeah, we fully back you in public. Now, in private, it appears that they've put a red line of sorts, that they said, we'll support you defensively all the way. We shot down quite a few of those drones and missiles that came through. So we're working on their side there. But it seems that they have put a red line on offensive operations against Iran. So we'll see how that plays through. So I mentioned options. Let's talk about them. The likeliest option is an attack on proxy militaries, primarily Hezbollah. This is generally seen as a fair option, as fair game without escalating the situation. Right now, depending on the numbers you look at, Hezbollah has anywhere between 50 and 100,000 missiles and rockets that are pointed at Israel. So when you combine that with the fact that Israel has already been massing troops on the northern border, and there have been several border firefights, it's not a big stretch to think that they'll just go ahead and push into southern Lebanon and do their very best to clear out some of the Hezbollah militants. I think that's the most likely option. I think that is not likely to escalate. The most aggressive option is attacking Iran's nuclear program and attacking it directly, because honestly, they've already been attacking it for the last 20 years. You can look at Stuxnet, the cyber attack, and you can also look at the fact that quite a few of the scientists in Iran's nuclear program have been assassinated. But again, that's indirect. On the direct side, we're looking at likely targeted strikes, most likely from fighter bombers. If that happens, you know that the United States is probably involved, and that's a big deal either way, because they would need our help most likely for both dealing with air defense, SEAD. They'd need refueling because they don't have some of that capacity, and then munitions. They need the bunker busting GBU-27s, which come from the United States. It's likely that if Iran was attacked via their nuclear program, they would see that as something that needs escalating, because I think they would see that as a very existential issue. So this is not good, and I really hope this one doesn't happen. Finally, there are a couple middle options here. This could be direct targeting of Iranian military sites and staying away from the civilian population, similar to what Iran did to Israel. Or it could be deniable targeting, such as cyber attacks against their power grid or other utilities. Um, Honestly, flip a coin if these are would escalate things or not. I really don't know. Sometimes it's kind of hard to say. Potential economic impacts of escalation are they're not great. 1/5 of the global oil crude supply goes through the Strait of Hormuz. When oil comes out of the Persian Gulf, it goes through the Strait of Hormuz into the Indian Ocean. Iran has the ability to at least temporarily shut that down. They tried it in the late 80s. It worked for a little while. They dropped mines all over the place. No, the US Navy ended up taking care of that. But again, that was not great. If that happens, crude oil is going to go up. Prices could go from the $90 a barrel right now to up to $150 per Bloomberg. If that happens, we could be looking at a 1% drop in global GDP and potentially a 1.2% increase in global inflation, because the price of crude oil affects things, everything from the price of food, super highly linked there, very high correlation, to the price of plastics, to the price of transporting all those items that we buy from overseas and that are then shipped. So this is could be a big deal. We don't know if it's going to be, but keep your eyes on the news. If those things happen, if it does escalate, if the economic impacts I just mentioned happen, these are the places I'll be looking. One is a flight to safety. Flight to safety means US dollar, it means gold, and it means short dated treasuries. Those are your safest options typically. The energy sector should be placed pretty well to take advantage of this. Likewise, agricultural commodities, because Israel is a major player in the global ag market. They do a lot of ag tech, and they're very important there. And then finally, aerospace and defense. Russia versus Ukraine. Not a lot to say here. Just know that it's a grinding war of attrition these days, and we're seeing just a lot of people getting hurt, a lot of people getting killed. Both sides are losing essentially an entire generation of young men. It's a tragedy. The biggest worry here is that if NATO becomes more involved, as of right now, we're sending supplies and we're sending money, but we're not sending troops. France, through President Macron, has, I believe, my estimation is that they're trying to take a larger role in world politics, because they're seeing disagreements and a lack of leadership from the United States. So they're saying this is an opportunity that he can step in and fill the void. So he has talked about sending troops to Ukraine. Will it happen? I don't know. If that does happen, that would escalate things. France has a much stronger military than Russia, so that's the good news. But there are also so many questions as to whether that would trigger NATO's Article 5 or any number of other things. But your big takeaway here is that I don't expect that will happen. I think right now it's saber rattling, and it's trying to position himself in a better place on the world stage. We are seeing the defense spending is going up. And across three of the areas I'll talk about today, defense spending is a big part of it. And that's why I've talked about the defensive sector. You're seeing Poland specifically has increased their defense spending. It's almost 4% of their GDP at this point. That's double what they're expected to contribute based on NATO guidelines. And that's because they've been invaded by Russia before. They know what it's like. During World War II, they were invaded. They had a huge massacre of their entire officer corps, those that wouldn't swear loyalty to Russia. And when you look at the rest of the list that's spending over the 2% or at the 2% level, I think it's interesting to see Poland, Estonia, Lithuania, Finland, Romania, Hungary, Latvia, and the Slovak Republic are all either Eastern European countries or countries that are close to Russia. So I would estimate that they're spending more because they see the writing on the wall that if Russia succeeds in Ukraine, they're probably not going to stop there. The economic and market impacts here are pretty low, so I'm not going to go into detail here. Just know that I think most of this has already been priced in unless a major change occurs. Chinese economic pain. This is my third point. I just know that the Chinese economy is not doing very well right now. Consumer spending is not doing great. It missed its estimations earlier this week, and their housing market is in a pretty terrible place. And when we talk about what their property market is and how much of it impacts their entire economy, you can see that right here. You know, in 2020, 2018 or so, it maxed at 23% of their GDP. Now we're down to under 20%, and that's expected to continue dropping. So that's a big deal, especially because so much of their GDP is based on that. When you look at culturally, they don't have a culture of investing, they have a culture of saving. Most of their savings goes to banks, and the banks end up lending that money back out to developers who put it back into property. So this is something that could potentially it could spin into something more like the United States in 2008 or Japan in the early 90s, when a real estate pullback really caused reverberations throughout the market. When we're talking about market impact on this, the only place you need to look out for too much is in emerging markets funds. Most emerging markets funds, at least the biggest two that I double checked, BlackRock's and Vanguard's, are about 20% invested in Chinese equities. And honestly, I don't invest in China at all these days, for both moral reasons, but also from these two graphs you can see. The one on the left is the returns of the iShares China ETF. This just tracks the Chinese stock market. It goes from 2011 till today. And my takeaway here is over all those years, the entire index is down 26%. Okay, not great. You know, no one wants to lose money over that long period. But when you look at the graph on the right, this is the GDP for China over the same period. It went from about 8 trillion to 18 trillion over that same period. So it more than doubled. The economy more than doubled, but the stock market lost money. That means that money is going elsewhere, or it's just not making money, it's just growing. But either way, that doesn't scream investment opportunity to me. China versus the United States. President Xi is trying to, again, just like with Iran, build a regional hegemon. They want to be the power in the Pacific. When you look throughout Chinese history, they have considered themselves to be really the sole center of the world, and follow that up to about 1839 when the first Opium War hit. That began their century of humiliation. From 1839 with the first Opium War to the second Opium War in 1860 to the Sino-Japanese War in the mid-1870s all the way through World War II, essentially, Warring States period on through. They had a really, really tough time. They were set back. They had a lot of treaties that were one-sided against the Chinese. And now, starting with Mao in the late 40s, on through Zhu Enlai in the late 70s through today, they've had a real resurgence in their economic prospects. Now they are the world's second largest economy by GDP, and they're growing faster than the United States. So they're expected to become the world's largest economy. She is also, I should mention this, used a lot of that money and funneled it back into the military to modernize the military. And this will be important in a minute. One of the biggest issues with China is that they are, excuse me, claiming almost the entirety of the South China Sea. They think of that as their personal lake or national lake, I guess. And if you look in the picture here, you can see what they call the 9-dash line. It's a pretty big deal. This is what they use based on a really old map to say that anything within that line is their territory. The problem is that line interferes with the territory of the Philippines, Brunei, Malaysia, and Vietnam, as well as Taiwan, and it actually includes Taiwan. So the problem there is we're seeing a lot of friction between China and their neighbors. So one of the things that China has done to actually fortify their claims is they built islands in the South China Sea, literally taken a shoal, built it out into a multi-acre island, put airfields on it, put missiles on it, and now they consider that part of their sovereign territory. But as we'll see, that's not great for anyone. They're incredibly aggressive. Talking about Taiwan, I mentioned that the 9-dash line included Taiwan. The quick history of Taiwan is the current government began in 1949 when Chiang Kai-shek, Chinese nationalist, fled from Mao's Red Army. He crossed the Taiwan Strait and set up the KMT government in Taiwan. Taiwan sees himself as the true China, whereas China, the People's Republic of China, sees Taiwan as a breakaway, seceding state, province. So one of President Xi's main goals is to reunify the two countries by 2027. He stated that he expects their military to be able to do that by 2027. You can look and you can tell that there's a lot of preparations involved because if you look at these two pictures on the top, that is the area around the presidential offices in Taiwan. On the bottom is a target in, I believe it's in northern China, but essentially it's just a military mock site that they can use to practice assaults on the presidential office building. I actually had quite a few pictures that were really similar to this, where there was some of the major Taiwanese airports and other areas, but I think that's a pretty good explanation, pretty good show that they're taking this very seriously. China's also being aggressive against the Philippines. When you look specifically, what's come up a lot is the Second Thomas Shoal. It's a really tiny little shoal. I think it's about 60 miles off Palawan. And it's part of the Philippines territory based on international law. It's been adjudicated in the international courts at The Hague. And China still is fighting them over it. So the Philippine Navy actually beached an old derelict ship on the shoal, and they have several guys from their Navy that are stationed there. China has been so aggressive recently that they had actually used their Coast Guard to come in close, and then use water cannons to try to push them off the boat, or to try to interfere with refueling and resupply operations. So they're being super aggressive here, and just know that the reason why the Philippines are so important, it's twofold. One, because we have a mutual aggression or mutual defense pact with the Philippines. So if the Philippines are attacked, the United States were, obligated to get involved. Second, the Philippines, we need to have them as a strong ally. One reason is because they're really well located. If anything happens in Taiwan and we get involved, we're going to need a logistics hub that's closer than Guam, that's closer than Hawaii. The Philippines has a great opportunity to be that. We had a naval facility there at Subic Bay up until maybe 2000 thereabouts. And it was actually one of the largest, if not the largest, naval facility in the world. And we will need that to refit and to work on planes and ships. So the Navy is reopening that, and they've been working on that for about 2 years now. Just kind of a quick breakdown of the Chinese military strengths versus ours, because I think it's kind of important to know. Chinese military has 4 strengths if we're looking against the United States. The first is location. any war that happened against the United States is not going to be expeditionary from China's point of view. It's going to be in their own backyard. So instead of having to cross the entire Pacific Ocean to bring supplies, they're going to be able to ship them via rail or by water and be right there. Planning. While the United States Navy and the United States military in general has had to fight, we got stuck in Iraq and Afghanistan over the last 20 years, wasted much time, money, and lives. China has been planning for one thing, maybe two if you count India, but they've been planning on how do they fight and counter the strengths of the U.S. Navy. And they've brought out advanced hypersonic missiles that are essentially carrier killer missiles, as they're called. That's a big deal. That actually, we have 11 super carriers, and those carrier killer missiles will likely keep our carriers outside of the first island chain. So it takes away some of our range, takes away some of our options. Next up is production capacity. China has the world's largest amount of shipbuilding capacity. If you look back to World War II, one of the reasons why the American entry was so important was the fact that we brought massive industrial capacity. Over the last 70 years, we've sent most of that industrial capacity offshore. We don't make that much anymore. To compare actual shipbuilding capacity, China has, I believe it is about 20 million tons per year, and we have 100,000. So they can outbuild us in pure tonnage by 200 to 1. And if you look at the example of the Liberty ships in World War II, quantity has a quality all of its own. And then finally, manpower. When you have over 1 billion people and you have a cultural view that life is relatively cheap, that also has a quality all of its own. So that's the bad news, but here's some of the good news. The U.S. military has quite a bit of strength as well. Naval strength, we have more gross tonnage. Even though they have more vessels, we have larger ships, we have more technologically advanced ships. Experience, our military has an incredible amount of institutional knowledge. The fact that China only recently, within the last 5 to 8 years, launched their first carrier. They actually bought a derelict carrier called the Varyag from Russia. It was originally a USSR ship that was junked, and they rebuilt it into their first carrier. We've been launching planes off ships since the 1920s, or maybe 1930s, but very, very early. And that's knowledge, that's the ability that you can't get overnight. And then finally, resources. China is a net importer of both food and energy. They receive a lot of their natural gas from Russia. They receive oil from Iran and others. And they also have to import food. And we don't have to do any of that. We are net producers on all of those things. And we do have the production capacity, if we spin it back up, to get back where we need to be. So the economic impacts of war, I can't say enough how big of a deal this would be. When you look at the last 30 to 40 years, and when we talk about inflation over the last 20 years being essentially zero, a large part of that is due to cheap Chinese goods and the fact that goods can be shipped worldwide for essentially nothing. If that goes away, all of a sudden goods are going to get more expensive and inflation is going to go up significantly. We're also going to have to bring so much of that manufacturing, if not back to the US, back to the Western Hemisphere. So countries to look at include Mexico and Colombia there. Both of them have really solid manufacturing bases. Also, semiconductors. When you look at semiconductors, specifically advanced semiconductors, 90% of them are built at the TSMC, the Taiwan Semiconductor Manufacturing Corporation in Taiwan. And semiconductors are kind of weird because they are typically designed in America, built in Taiwan using Dutch machining and glass from Germany. So it's a very worldwide interconnected supply chain. One thing goes wrong there, all of a sudden we don't have the number of chips that we need. And these chips are the chips that power cell phones, they power cars, cameras, your smartwatch, TVs, the MRI, the CAT scan machine at your local hospital, even your vehicles. So it would be ugly. I live here in Louisville, and in Louisville, we have a Ford plant. Post-COVID, there was a chip shortage. I'm sure everyone heard about that. And there were hundreds of Ford pickups parked all around town because they didn't have one specific chip they needed to be able to send them out. So expect that it will be something similar to that, except for an order of magnitude worse. Stock market impact of that, honestly, I have no idea, except for that I know it will be bad. I'll just leave it at that. I can't even start quantifying what the number looks like. Two more things. I'm going to keep these pretty high level. First is demographic shifts. The world is getting older by 2030, not too far away. 1 in 6 people in the world will be over the age of 60. You can see from the graph, as the colors get darker, that means people are getting older. Specifically in Europe, Japan has the world's oldest population, South Korea, and then the United States and China as well. Although the United States is relatively younger than most of the rest of those. The reason why this matters is as we get older, our spending and our production changes. From this graph, you'll see that your labor income, your production, maximizes around the age of 25, goes until 59, 60 whenever you retire. At that point, you shift from producing to consuming. Not a bad thing, but it's just the way of the world. So your consumption goes up, production goes down. We have less folks that are in the younger demographics. And I don't have the demographic chart on here, but in the United States, when you look historically, it was kind of bell-shaped, or almost like a pyramid, actually, that as folks got older, it was a smaller and smaller slice of the overall population. When you look at it now, and especially projected out to 2050, we're seeing essentially a column because folks are living longer, and the younger generations are having less children. So essentially, you're not seeing the fall off between different generations. And the big reason why this is important is one, the consumption that I mentioned here, and two, going back to Social Security. If you look at the number of workers that are paying in, and then compared to the numbers that are taking out income, historically it was about a 5-to-1, 5 workers for every retiree. Now we're down closer to 3-to-1. And so that's something just to be aware of. Also, the cost of healthcare is going up. And I'll touch on this. You'll see this on my investment slide. But of course, the older you get, the significantly more expensive your healthcare gets. You can see it's about 50% higher as soon as you hit retirement than when you were in your peak earnings years. And then that really almost triples by the time you are 85. Finally, aging infrastructure. That when you look at our infrastructure in the United States, it is a product of the post-World War II expansion. The Eisenhower interstate system, many of the bridges, roads, railways, even things like the power grid and the water supply. So right now we have a $2.6 trillion infrastructure gap that if we don't address it, it could cost the US $10 trillion in lost GDP over the next 15 years. That's a huge deal because as you can imagine, if talking about infrastructure, if your roads are worse, if it is more expensive, if it takes longer to ship goods, if your airports are not up to snuff, and if they're not able to get people where they need to go, there are costs to that, both time and money. So breaking it down into 3 different areas. On the transportation side, it's where most of the money is going to need to go to. 1 in 3 bridges needs to be replaced or repaired, and that's a lot across the United States. Water and electricity, when you're looking at the estimates, the EPA put a $744 billion price tag over the next decade on drinking water and wastewater as well, because that all goes together. And then finally, internet. And you might think, hey, internet, is that an infrastructure? But in reality, especially in the post-COVID world, when folks are working remote, having a fast, reliable source of internet is honestly non-negotiable. The biggest thing here is the middle mile, which is the longest portion of the broadband, which gets it to where the final mile, and that's where the local providers take over. So investing in a changing world. We're in a very changing world, and how do you protect your money? How I do it is I use a core and satellite portfolio. The core, and I'm just talking about stocks today. I'm not really talking about bonds much at all. But on this core side, that's going to be your passive indexes. In my current portfolio, I have US large cap, US small cap, and I have international and I have emerging markets. That typically doesn't change too much. And that's going to be about 70% of a portfolio. The satellite is what I consider more the tactical side of things. And that's where when I'm going through the risks and the opportunities like I just presented, I'm looking and saying, okay, where can I get the best risk adjusted return based on what I see in the market? This is usually going to be 4 to 8 different investments broken down evenly within that satellite portion of the portfolio. So just breaking down what I've already said, there are 4 investment themes that drive my investments as of today. First is geopolitical risk, then persistent inflation, which I didn't really touch on, but I'm sure you caught through a lot of those that I think structurally over the next 20 years, we're going to see higher inflation than we saw in the last 20 years. Instead of having sub 1% or 1% inflation, I think it's likelier that we have 3 to 4% inflation over that time. Infrastructure spending and then demographic changes. So back in January, I sent out an email to, most of you probably received this, just saying, this is my forecast for the year. This is what I expect is going to happen. Or this is what I think is going to happen. I mean, you never know, but this is based on what I see. This is where I think things are going to go. Breaking it down, the Middle East situation will devolve as Iran takes a more active role. Check, that happened. Inflation will increase in the mid to latter part of the year. Half check, because inflation's already rising and we're not at the mid part of the year, but I kind of got part of that right. Federal Reserve will hold or cut rates by a minimal amount. Yeah, we're kind of there. When you're looking at economists, they're pretty much resetting their expectations. Treasury yields have risen, going back to the 10-year total return negative 2.91% that I looked at a minute ago. That's happened. What we haven't seen at the moment is consumers spending less, because I showed the consumer spending that's still going up. So that's still to be determined. Consumer preferences changing has also changed, or has not changed yet. I'm sorry. People haven't really put off major purchases based on that consumer spending. And then finally, commodity prices. Commodity prices are up right in line with the S&P for the year. Depending on the index you look at, it's somewhere in the 5 to 6% range for the commodity indexes. So that's kind of a check as well. So just so you know, I'm always looking at research from across the board, whether it's Vanguard, Schwab, BlackRock's information I like a lot. So I went and pulled their views just because I think it's always interesting and good to get a double check, and it gives me an ability to course correct if they point out something I missed. So looking at their big calls for the year, they are overweight U.S. equities. They mentioned putting the income back in fixed income. And I like that too. One of the things I've done for a lot of clients is say, okay, you have cash sitting in the bank that's yielding 0.25%, 0.5%. Let's put that into a money fund or a money market that, or even a high yield savings account so you can get at least 4 to 5%. Not trying to beat the market there, but if you're trying to keep your money relatively safe, but actually get a decent yield, it's there these days. Also, talking on the fixed income side, and I won't get into this too much, but I really like bond ladders for most people these days. I'm staying away from bond funds because I think most bond funds take too much risk. All I'm trying to do when it comes to fixed income is make sure that people are getting the income they need when they need it, and I'm happy with that, and staying relatively liquid as well. I'm not trying to beat the market with my bonds. I'm trying to make sure that when a retiree says, hey, I need my monthly check, that money is ready for them. I think the bond ladders are probably the best way to do that. Their other tactical call is geographic granularity. Japan, they like Japan. They also like India and Mexico. I mentioned Mexico as a manufacturing base. India is interesting because it has a much younger population and they're expanding as there's more Western influence, essentially. Many companies are starting to expand there. They have a huge population. Then on the strategic side, private credit, inflation-linked bonds, and then short and medium-term bonds. I mentioned the bonds. Again, this is where I don't want to take a lot of risk. I'm not trying to take buy a 10-year bond or a 30-year bond. I think those are going too far out, and there's too much risk of inflation or rising interest rates there. They're not worth it. I'm trying to stay liquid and on the shorter end of the curve, 1 to 5 years. So the three places that I'm investing are inflation hedges, defensive sectors, and then the actual defense sector. And here's how my actual portfolio breaks down. If you notice, I'm not using specific tickers because I'm not giving investment recommendations here. This is all education. None of this is a recommendation for you to buy any of this. But I want to tell you how I'm doing it and my thought processes and how I'm approaching this. So when I break down a portfolio, you can see the top domestic and international. That's the core portion of the portfolio. In this, it's 70% of the portfolio. So I break down my domestic stock allocation to large cap growth, large cap value, and small cap core. That's pretty much the entire US index. I'm overweighted to value a little bit. I might be a little early on that. Honestly, I'm not sure, but growth has done really well over the last 10 years. But I think it's time to go ahead and see a mean reversion so that they typically balance out over the long term. So I'm overweighting the value a little bit. On the international side, I'm looking at developed international, which are Europe, Japan, South Korea, Australia, those countries, as well as emerging markets, except for China. I use an emerging markets fund that is specifically emerging markets, but no China, because again, I don't think it's investable. And then on the satellite portion, this really breaks down into a couple of different areas. The inflation hedges that I mentioned, the gold and commodities, those are places that are traditionally pretty good hedges against inflation. Technology is also a hedge against inflation, but it also is just a great place to be, because a good place to be, because it's had really solid returns. And with the AI revolution that's going on right now, I don't see that changing anytime soon. Healthcare and infrastructure are more strategic long-term holds because of the demographic and issues that I mentioned a few minutes ago, and the infrastructure issues. That's not a short-term play. That's not a 6-month or a 1-year investment. But I think over the next 10 years, those should both be pretty solid investments. And then finally, defense. When we're talking about companies like Lockheed Martin, Northrop Grumman, Boeing, I'm not going to recommend any of them specifically, but just saying that for every missile that's launched in the Middle East, it was bought somewhere. And so I think with the amount of volatility that's going on in the world, I like having an allocation to defense. And that's about it. I appreciate you joining me today. I just do want to give my quick pitch and just say, if you want a second opinion, I'm always here for you. I typically see that there are 3 places where most portfolios go wrong. The first is that people are taking either too much or too little risk. And you might be thinking, too little risk, what do you mean by that? I would just say that most people don't know what amount of risk they're taking. So you need to make sure that based on your goals, you have the right amount of risk. The next is expenses. A lot of portfolios that I see have 20 different funds. They're almost always actively managed mutual funds. They're really expensive. And so these actively managed mutual funds, just because there's more of them doesn't mean that they're better. So if there's a place where you can get solid or equivalent returns with less expenses, that leaves more in your pocket. And then finally, taxes, because particularly if we're talking about regular non-qualified investment accounts, taxes matter. The less you pay in taxes, the more you keep in your pocket. And so there's a lot of ways you can structure a portfolio and make sure that you have the right investments in the right account, whether that's Roth IRA, traditional IRA, or a non-tax or a regular old taxable investment account. And again, you can make sure and you can optimize your portfolio so that your growth is happening in the best places possible for you. So these are the 3 things that I always check for all of my clients. And if you want just a completely free portfolio review, I'm happy to put one together for you. So either shoot me an email, jeb@plentifulwealth.com, or sign up on my site to get a free consultation. Thanks.